You're watching Stockwatch. I'm Simon Brown. Joining me to unpack your stock-related questions today, Alex Duys from Umthombo Wealth, Cobus Potgieter from Southern Cross Capital. Be sure to send your questions through email, stockwatch@bdtv.co.za, SMS 41392, or on Twitter @BusinessDayTV using hashtag Stockwatch. Gents, appreciate the time. Alex, let's kick off with you. Let's kick off with US markets closing at all-time highs on Friday. Futures are green today. I mean, in one sense, I love myself all-time highs. It means I'm generally richer than I was previously. The flip side is, does it not reopen the debate from late last year around valuations in US markets? I mean, we're not seeing massive. In fact, growth has been pulled back. Alex, your thought on those highs and if they a worry, or do we just enjoy it?
Well, the volatility in the US market has certainly been interesting to say the least here today thus far. I think it's important to note that even though the market's hitting all-time highs, it's quite a narrow type of, I think it's only about 7% of the shares, S&P 500 is actually hitting all-time highs. So once again, it's your big mega cap AI-related stocks are doing very well. And you are seeing some recovery in some other stocks, but even like a Nike, which is up 15% on Friday, it's still actually down year-to-date and so forth. So there is still, I think, underlying economic activity, perhaps a little bit under expectations, and as a result, you're seeing some of those companies, call it pure US-related exposure, not doing that well, but certainly those that's got more offshore earnings as well, global companies are doing very well. So yes, with heightened risks going up, you don't necessarily want to buy at all-time high valuations, but the fundamentals could persist going forward, and it's difficult to say.
Cobus, that's part of the trick, is timing the top of a market is a mug's game. I've got my fingers, but I've got it wrong before. Your take on the all-time highs. I mean, as I say, it's nice because we're equity investors. It means we're richer. Does it make you worry a little just in terms of valuations?
Just, I guess, to underscore what Alex has already, alluded to, we should probably be talking about AI bubbles more than anything else. We've certainly seen a lot of the most tariff-affected stocks still haven't returned to those pre-tariff levels. So in terms of general market sentiment, yes, demand seems quite robust and the economy remains resilient as it stands. Of course, looking forward to those jobs numbers coming out later. There is still opportunity, frankly. If we look outside of those, the Magnificent Seven, in particular, towards stocks and other sectors. I wouldn't say, the general equity market is that hot, and even the multiples on something like the Russell isn't as expensive as it has been during previous bubbles. But AI in of itself and the sustainability of that and the ability of these companies to continue to attract capital, never mind reach profitability, because that's a long way off, with the exception, of course, of Nvidia. That's that's sort of a thesis in of itself, similar to .com, but quite concentrated in that sector. More generally speaking, I wouldn't be scared of the markets, but I would be, honestly, we have divested from those big names in a big way.
Yeah, but I like your point. There is opportunity, as Alex said. It's like the mega caps. There's a lot else there that aren't those sort of giant stocks that are maybe offering some value. One of them, perhaps, Cobus, let's stay with you a moment. Invicta results side, a question came through. Not a bad set of numbers. Stock hasn't done much. Am I wasting my time in this business? Cobus, your take on Invicta, on the numbers that were out this morning?
No, I'm a little bit far from Invicta. We've sort of disliked that stock for a while. I don't know if you perhaps have a view on it, Alex.
Alex, Invicta for you?
Yes, yeah, certainly. So I thought it was a very good set of results. Specifically, H2 was much stronger than H1. I think there's obviously some corporate activity has been happening there. So, for example, they bought back the preference shares. Yeah. Over 700 million. Yeah, that's quite a headwind to all ordinary shareholders. So that income is going to flow now through to shareholders, which is obviously a positive. They also sold properties in Hong Kong through their Kiana subsidiary, and they've used that to pay down debt and so forth. So I think the business is relatively well positioned. You're starting to see ROEs picking up. There seems to be still decent growth coming, and they are very focused on shareholder returns. I mean, in this set of results, I'm talking on a correction here, but I think they gave about 900 million rand back to shareholders, which is quite a sizable number considering it's a small cap stock. Stephen Joffrey's done a very good job there, and I think we will continue to do so. There is some risks, specifically with the global tariffs. I mean, they do have, for example, export a lot of their products from China, and they have to circumvent that through Japan and other places. But I think the business is well positioned, but it does need some economic growth, specifically locally. But they are trying their best to invest in other jurisdictions like the UK, for example.
Yeah. And the point, they would like some economic growth. I think everyone would love some economic growth. Alex, let's stay with you. ABSA question is, South Africa's cheapest bank, it always has been. Is it maybe starting to turn? We're getting a new CEO. The update wasn't too bad. It has been, Alex, ABSA's always been the cheap one. Some people love it. Some people prefer the others. Where do you sit on the ABSA debate?
Yeah, certainly on a relative basis, ABSA deserves its discount rating compared to others. So I think that's important to note. But whenever you buy a South African bank, in my view, below price book of 1, it's very likely they're going to make money over time, especially if you do believe they can grow earnings from this base. And I think in the case of ABSA, they tick both those boxes. So yes, the provision profits seem to be quite muted at the moment, and that's due to lack of advances growth, which is directly tied to economic activity as well as low interest rates. But they are doing slightly better in the transaction side of the equation. But credit loss ratio is going to reduce. Yeah. And that's going to mean that earnings is going to increase going forward. It can probably still pull that lever for the next year or so, but after that, you'll need to see some more, call it operational earnings to come through. But I think it's well positioned. It's very, very cheap. And if the forward dividend yield must be in excess of 9. So I think you could do certainly a lot worse than buying ABSA.
Cobus, your take on ABSA? Amalgamated Banks of South Africa.
I mean, my very first bank account was a Volkskas denim card, in fact, which my folks got for me back in the day. No, I mean, I broadly agree. My first employer had a thing for stocks where the yield exceeded the PE ratio, which is the case in this case. ABSA in particular, pretty well positioned. I think most of us have grown frustrated with the pace of interest rate cuts from the Reserve Bank, but ABSA amongst the four are the best hedged against that, call it reverse endowment effect, where the spread between the borrowing and lending for the banks tends to expand during a hiking cycle and compress during a cutting cycle. They are better protected against that, better hedged against that versus the other players. This update, a little bit light on color, but we've seen Ghana in particular turn around, which protected them against quite a robust rand relative to those other EM currencies, meaning as a basket, they didn't lose on a currency basis in the rest of Africa. And of course, that credit loss ratio is substantially improving even further. I think just given how cheap it is and how aggressively they have been returning capital to investors as well, it's quite an attractive hold at this valuation.
And I agree 100%. PEs above, dividend yield above PEs always. Sometimes it says the business is going bankrupt, but in the case of ABSA, not the case, and always going to be attractive. Cobus, staying with you, a question coming through. Please ask your esteemed panel a simple question. Dis-Chem or Clicks, which would be their preference? Cobus, I give you a third out there. Maybe you don't like either of them. Dis-Chem or Clicks?
Honestly, I love both.
Or both?
Okay, well, let's just chat about the thesis for both. Essentially, both of these businesses have dispensaries at the back of the store. You have to walk through the store to the dispensary largely. Where your pharmacists sit, almost acts as a type of a loss leader or a lower return unit within the business. But you've got to walk through, and maybe on the way you'll pick up some cosmetics and accessories and such. And both of them have been acquiring these, call it localized licenses or pharmaceutical permits as they go. And again, there's policy that limits the amount of pharmacies that are allowed to operate within any given area. So it's been slowly consolidating that industry. Clicks a lot faster and somewhat, smaller format, whereas Dis-Chem is more of a big box format. But both are really good businesses. Clicks is high quality, proper independent management, been going for ages, well managed. Dis-Chem, because of the founding family situation and some remaining conflicts, some of them have been addressed, but I believe the family still have shares in the largest DC in Midrand. So that's a bit more of a tricky situation. But taken all together, we like both, and we'll be in either or both and rebalance that in either direction depending on valuation. I believe at current valuation, I probably prefer the Dis-Chem.
Yeah, and I love your point. I go there, I buy my prescription, and on the way out in the queue, I buy chocolates, and I'm wondering, is this not counteracting my healthy prescription? Alex, Dis-Chem, Clicks, either, neither?
Yeah, I agree with that, Cobus. I mean, these are buy and hold type of companies. They're pretty much compounders, right? So if you're going to buy these, you're probably going to hold them for 5-10 years, and before you know it, they'll double that earnings and over that base, and the share price will follow suit. I think Clicks for me is the better of the two options. It's probably got less growth compared to Dis-Chem, but I think if you look at the financial metrics, it's absolutely world class. It deserves its premium rating. Also see a lot of foreigners do like to buy Clicks for that reason. They also respect shareholders' capital. You don't really do all sorts of acquisitions and so forth. So I think these are very high quality businesses with structural growth stories, as Cobus laid out. I guess in our ideal world, I probably would like to be able to pick Clicks up at a slightly better valuation. So if there's any form of pullback or a region of 10%, it's probably a very good entry point. But it deserves its premium PE rating. Of course, it's backed by cash. I think the cash earnings is actually probably about 50% higher than the accounting earnings. So that's why they're able to do the capex, pay the dividends without using debt, rolled out, and so forth. So yes, that's my preference. Clicks over Dis-Chem.
A recent listing, although it's a dual listing out of the UK, Green Coat Renewables. Question coming through. Please ask the guests if it looks like a good investment. Alex, if you had a look at it, they've got what? A couple of gigawatts of mostly onshore wind power in Europe. Your thoughts, if any?
It's on still my to-do list, Simon. I haven't got a chance to go through it yet.
Cobus, have you had a chance to have a gander at it?
No, unfortunately.
No.
I mean, noticed it, but it hasn't traded a single share today. And I mean, when these things are that liquid, it tends to get bumped down the priority list.
No, 100%. It's got a nice, the dividend yield's around 8 to 9%, that obviously in euros, but it is deeply illiquid in many cases. Cobus, stay with you. A question coming through around PGMs. Is there still time to get into PGMs, or have I missed the bus? In some ways, it's a question on what you think is going to happen to the platinum prices, which is not easy. But would you be looking at PGMs? Deeply cyclical, and certainly, I mean, is it fair to say closer to the bottom than the top, or am I being still a little optimistic there? Cobus?
No, I mean, that's a difficult call. They have recovered significantly relative to the suppressed level of the last 24 months or so. The share prices, I'd say, probably don't reflect that optimism altogether. So taking an express view on platinum, we've seen a slowdown in the trend around widespread electrification, and of course this trend in the automotive sector where it seems that manufacturers are shifting to concentrate on hybrid and plug-in hybrids again. That in the long run obviously benefits the platinum sector, and to some extent that pricing in the spots has started to reflect that. It's still actually nearer the bottom in the long run than anything else, particularly if you keep an eye on that platinum to gold price ratio. So there's probably still some value in the platinum miners from this level. That's not, given it's almost like trying to forecast the value of oil down the line. It's a tricky one, and it'll never be a high conviction view in our portfolios.
Yeah, and saying it's close to the bottom is easy. Saying it's going to get to the top part, that's the harder. I mean, in my lifetime, or Alex, PGMs for you?
I agree with Cobus, his views on that one. But a couple of things I want to highlight. I mean, the movement in the platinum price has been extraordinary.
Yeah.
It's pretty much hit 10-year highs in a very short period of time. I've been able to get different views from my service providers in the industry. So it was obviously there's indication that the Chinese are buying more from a jewelry perspective, but that doesn't seem to be fully backed by evidence that I've got at the moment. And lots of investor speculation that's getting involved in PGMs at the moment. So I think you're seeing a lot of ETF buying and so forth that's pushing up the price. And obviously some of the developments happening on from, as Cobus referred to, from the BEVs and so forth is good. But yeah, so it makes it difficult. I'm not sure if it's sustainable or not. I think it's pretty much like might throw a dart or two and see what's going to happen. I concur. I don't think it's high conviction. It can go either way. But if it does remain high, then the share prices are probably still undervalued. So it depends on your view. Oh, another point I want to highlight, we haven't really seen palladium and rhodium follow the same suit as platinum. So that is for me a little bit weird, especially rhodium, which is extremely geared, extremely rare, of course, and it's usually from UG2 mining as well. It's usually a byproduct of that. So either they're going to follow at some stage, then the share prices are really going to go up, or we could perhaps see a bit of a dead cat balance in the platinum price.
Yeah. But I take the theme from both of you. This is not high conviction by any stretch. I mean, we can almost say it's speculation to a degree. Alex, Aspen, question coming through. What's your take on Aspen? They, of course, got hit hard earlier in the year. Is Aspen on your shopping list, or is this an avoid?
Not really, Simon. I haven't really liked the strategy for a number of years. We had some concerns about the quality of earnings in the business. And there seems to be the market's darling always. I mean, whenever there's some sort of story, investors buy into it, but it's been serious disappointment now. I think there has been impairment to the investment case. But saying that, it's probably screening the most attractive is done probably in the last 7 or 8 so years. And if they can fill that manufacturing capacity, which they've lost now out, that it could be investment case, but it's not necessarily an area that I think that's screaming out to me that I need to get involved in. I think it's trading pretty much fair, but perhaps some upside surprise if things work in their favour. Yeah,
I mean it's that capacity they've got, and now with the contract challenge, even more capacity. Cobus, Aspen for you?
Precisely the same. Perhaps I'm a little bit more bullish on the potential upside from from this level. It certainly has taken a significant governance hit, and there's a lot to be said. About the way that they communicate to the market, and of course the quality of earnings and the risks to that. But given the entry point we're seeing at the moment and how much excess capacity there is, for which there is certainly demand, if the in the short term run, we still don't know the details, but it does look like this was almost a direct consequence of tariff pressure and onshoring having to occur in the US. But that doesn't mean there aren't other markets that are not interested in these high tech facilities for vaccine manufacture.
Yeah, I mean, they do have them. The one down in Cobus and then, of course, in France as well. And they are really good facilities. Cobus, to stay with you, a couple of questions coming through around Billiton, Anglo-American, focusing on the copper aspect and saying, looking for some copper exposure. There's some small miners, but I want one of the big ones. Which would be better from that perspective? Cobus, they've both got copper. They've both got iron ore. Anglo, of course, just got out of most of their Volterra stake. Which would be your preference if you're looking for copper? Or is there perhaps a better copper option out there?
Well, just to focus on the two, I always love a little bit of free optionality. And on that basis, I mean, you've mentioned they've right-sized it. There's some more simplification to come in Anglo. They have to sort out some of those other now identified as non-core assets or assets trading at a discount as well. But that process is ongoing, and of course it's clearly in play. And we've seen an offer already. I need to check the deadline on the put up or shut up. For the Billiton offer in particular, that might have come and gone, but on that basis alone, and perhaps getting a little bit more little bit more exposure overall than you would in the likes of a Bullets. And of course, everybody's trying to rush to copper now, and as we've heard famously, it takes 20 years to put up one of these assets. So that's the reason people are sniffing around and looking to grow their exposure to copper acquisitively, which is precisely the reason that Anglo's was an attractive target for BHP in the first place. But on that basis, we still like Anglo's. And we like the continued simplification of that business. I guess that doesn't answer your copper question specifically. I like the COPEX ETF, which is listed in the US
yes.
as well.
Yes, of course. I forgot.
That's quite a nice way to get a diversified basket that is quite pure copper play.
Yeah. Alex, copper, Anglo, Billet, and certainly they've both got copper at a lot of it. Your take on the two?
I agree there with Cobus. I mean, so Anglo's got world-class copper assets. And after the simplification of the business, it will have a high component of your earnings will be coming from copper relative to a billet. So if you're looking for purely copper, I think that makes more sense. Another option, of course, is Glencore, where copper is also quite material there. And if there's a bit of a recovery in the coal markets, you'll get an additional coal option there in Glencore. As we know, metallurgical coal has been under a lot of praise as well as thermal coal here to date.
Alex, you mentioned Nike earlier. I had a question coming through my Twitters over the weekend around the results. And it's simple. I mean, I think what you said was up 15, 17% on Friday. I don't know if you had a look at the results. I could see a scratching of a turnaround, but my sense is perhaps still early days there.
Certainly still early days. And I think that for that whole sector as well. I mean, even if you look at Under Armour as well, they're going through restructuring. Puma is going through trouble as well. So in the case of Nike, has still got, I think, over 7.5 billion in stock. So they've still got a lot of stock they need to work through. But they've been working through some of the bad stock. Obviously made some mistakes in the channels in the past and so forth. So it's not necessarily about the current results. It's more about the prospects. And I think that's what's getting the market a little bit excited. They are certainly giving a more rosier picture going forward, but it's not going to be a quick fix. It'll probably take a few years. But at the same time, not doing that particularly well in China as well, of course, right? We used to be a big growth area for them. So it's a couple of things that still need to be sorted out at the time. But in my personal capacity, I own some Nike, and I do think it seems quite interesting that they can turn it around.
And that is a lot of pair of sneakers that they've got sitting in their storeroom, literally billions. Let's go to some stock picks. We haven't got time for your view, Cobus. But Cobus, you're going with Reinet. There were a couple of questions coming through around the rumours this morning. The sense was response to recent speculation. They have had an offer for their PRC business, and it's your pick today.
Yes. So we had, I guess, reasonably robust financial journalists calling a 45 billion pound deal for roughly a 50% stake, and of course in Penscorp, and of course Reinet owns 49.5. So they will certainly be part of that conversation. Part of the reason we have reiterated this as a buy is that this essentially becomes a new peg in terms of the valuation of that business. Yeah. To give you an idea, the last carrying value, and the nice thing about Reinet is because of the Luxembourg listing, it does report full earnings every 3 months. The carrying value for that stake as of last reading was 3.4 billion. So writing that up to call it the mid-range or even the bottom of the range, 4 billion for that stake. I mean, given that it seems that these things are in play, and that's been quite a coherent strategy of the private equity players in collecting these pension fund benefits companies, they are quite attractive. And Penscorp has been executing particularly well under the leadership of some phenomenal management. So there are sort of two likely outcomes: is they sell or they don't sell. And then if you want to follow your binomial tree somewhat further, is it then worthwhile for them to remain listed? Yeah. Do they collapse the structure? So even if they don't accept the offer and remain listed, this becomes an enormous, call it write-up in the potential value of their most significant asset. So that unlocks significant value, and that, frankly, at the spot price is not even being reflected. If we rewrite those assets up to the bottom of the range, it's still trading at around, call it a 5% short of where it should be relative to what the implied value of that asset on Friday. And if they do end up selling, and as a double whammy, collapsing the structure and returning capital to investors, there's more than 50% upside from this level. So on that basis, there's a lot of optionality here. We think it's undervalued even if they do refuse the deal, but there's a high likelihood of some sort of deal unlocking significant value for shareholders. Yeah.
A ton of cash there. Alex, Altron, been a pick of yours before, a good business and looking better by the day in some cases.
Yeah, certainly. I've been very impressed with what management's been doing there over the last couple of years, and I think there's still more to come. So I think specifically the platforms business, which is more annuity type business. Mm-hmm. Think of your a Netstar and your fintech and so forth. I think there's probably strong growth coming from those businesses, and I expect very strong earnings growth, probably in the region of, call it 15%. But I think the key for me is if you look at the cash earnings of this business, it is substantially higher than accounting earnings. And one of the reasons for that is because of the depreciation policy they use on these actual devices at Netstar. Gotcha. Now, they are going to consider to change that. That is going to change, and I think it's certainly justified to change that. That's going to mean even higher earnings growth and higher ROEs, and I don't think that's reflected in evaluation or in consensus earnings numbers. So I think there's a price to both sides. So as a result, I think you should look to buy it now, and you'll probably get the benefit 6-12 months from now.
I like that. A small tweak in the earnings, and suddenly a whole lot gets unlocked. But we'll leave it there. That's all for Stockwatch today. Thanks to our guests, Alex Duys, Umthombo Wealth, Cobus Potgieter from Southern Cross Capital. Up next, to close, stay watching.